The loan that you choose today could end up costing you or saving you tens of thousands of dollars in just a few years. That's the real risk if you don't fully understand your mortgage options, especially adjustable rate mortgages or ARMs. Hi there, it's Luna Petty with Unyque Financial, and in this video we're breaking down ARMs, how they work, the pros, the cons, and whether they're a smart move in 2025 or a financial trap waiting to happen. Let's dive in and help you avoid making any costly mistakes. An adjustable rate mortgage is different from a traditional fixed rate mortgage. With a fixed rate loan, your interest rate stays the same for the entire term of the loan. But with an ARM, the interest rate can change over time. Most ARMs start with a fixed rate for an initial period, usually 5, 7, or 10 years. After that, the interest rate can adjust up or down based on the economy and market conditions. This means that your monthly mortgage payment can either increase or decrease over time. Let's break down how ARMs work. If you get a 5-1 ARM, for example, the 5 means that your interest rate stays the same for the first 5 years. The 1 means that your interest rate can change once a year after that. When the fixed period ends, your new rate will be based on a financial index plus an extra amount called a margin. If the interest rates go down, your mortgage payment could decrease. But if interest rates go up, your mortgage payment could increase. That's why some people see ARMs as risky, while others see them as a way to save money in the short term. So, is an ARM a good idea in 2025? Let's take a look at the pros and the cons. One of the biggest advantages of an ARM is the lower initial interest rate. Since the starting rate is lower, usually than a fixed rate mortgage, your monthly payments are more affordable at the beginning of the loan. A lower payment can also give you more buying power, allowing you to qualify for a larger loan and potentially afford a more expensive home. Another advantage is that an ARM can be a great option if you plan to sell or refinance before the rate adjusts. If you plan to stay in your home for just a few years, you might never have to deal with that interest rate increase at all. If the interest rate drops, your payment could actually go down after that initial fixed period. But there are also some risks to consider. The biggest concern is the uncertainty. Once the fixed period ends, your interest rate can increase, and that means that your monthly payments will be higher. This can make it harder to budget since you won't know exactly what your monthly mortgage will be in the future. Another potential downside is the cost of refinancing. If you want to switch to a fixed rate mortgage later, you might need to refinance, which could mean additional fees and closing costs. So, should you choose an ARM in 2025? Well, that depends on your situation. An ARM might be a smart choice if you plan to sell or refinance before the rate adjusts, if you're comfortable with some risk, or if you want to take advantage of a lower initial monthly payment. But if you prefer the long-term stability, if you plan to stay in your home for many years, or if you don't want to worry about changing of the interest rates, then a fixed rate mortgage might be the better option. At the end of the day, the right mortgage depends on your financial goals and your comfort level with it when it comes to risk. If you're still unsure which loan is best for you, we're here to help. For more information, be sure to connect with me. Thanks for watching.